Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Tupperware trades at just 5 times the last 12 months' earnings and 4.56 times its forward earnings. And that's about as cheap as a stock gets. But with a 10-year revenue growth rate of minus 2.75%, it's hard to fall in love with this company. To combat the slide, the board put Miguel Fernandez into the role of president and CEO. And with a new team of executives, the company aimed to create a more digitalized and data-driven approach to revenue growth, while restructuring operations to become more efficient. So far, things are looking up. The last 12 months of revenue is the first increase compared to the prior year since 2017. Margins also began to improve, yet cash flow is at its lowest level in a decade. Heck, the stock came in dead last in the top searches for packaging and container stocks by financial pros last month. So it's not as if folks are clamoring for shares, but maybe they should be. Now, as a packaging and storage consumer products company, Tupperware has been around for more than 75 years. The new CEO, Miguel Fernandez, has focused the company on selling off non-core assets, paying down debt, and rolling out a new growth strategy with an eye towards eco-friendly products. And as we mentioned earlier, Tupperware has only recently started to see its financials turn around. What's interesting is that even though revenues and margins improved, net income fell, as did operating cash flow. So what happened? Well, the company took a huge hit on disposal for discontinued operations, and the loss was listed at $148.1 million, which hit both net income and cash. Otherwise, cash from operations came in at around $136.2 million for the 39 weeks ending September 25th. All in all, the company's business looks pretty good. We want to note the company carries hardly any long-term debt and around $500 million in short-term debt. And in terms of valuations, when we said Tupperware was cheap, we weren't kidding around. While the forward price-to-earnings ratio does look ominous, the non-GAAP version paints a truer picture of what we can expect given the discontinuing operations. Incidentally, if you adjust the price-to-operational cash flow for these items, you get a nice 3.52EX. In our opinion, this is a 9 out of 10 ranking stock. Tupperware appears to be turning around its business line. Even though shares have run considerably, if they start to show any type of growth, the stock could really take off. And even if it doesn't, normal business operations would generate nice cash flows. Click and subscribe to the Spill newsletter to get the full breakdown.